Welcome to Real Estate Hot Wired. Maggie Rose March will be your host today. She is an informed voice for the novice investor, a voice of reason for the seasoned investor. And we'll be right back.
Hi, I'm Maggie Rose, and this is Real Estate Hot Wired. Today, we are welcoming back Tony Moore from GULFSIDE Mortgage and continuing our conversation about the golden age of real estate, managing your real estate portfolio. I have been looking forward to your visit with us today on Real Estate Hot Wired, and I want to take a minute to introduce you once again to our audience, Tony. Tony Moore is the co-branch manager and licensed loan originator of GULFSIDE Mortgage Services. He is originally from Cincinnati, Ohio, and moved here to Sarasota County over 23 years ago. Tony began his career as a mortgage loan originator in 2002, and he and his wife took over GULFSIDE Mortgage Services in 2010. He is also currently the chairman of the Venice Area Chamber of Commerce for 2020. Tony is a respected professional in Sarasota County and is dedicated to helping people and helping his community. Tony, welcome back to Real Estate Hot Wired.
Thank you, Maggie.
Oh, I'm so glad you're here. And if you missed any of last week's broadcast, you can catch up with us on societybitesradio.com. So last week, Tony, we spoke about the real estate market and the recession, and maybe we should refresh that for the audience, say the market today versus the market in 2007, just to give them some confidence in where we're starting from today.
Yeah, absolutely, Maggie. That's a huge question that a lot of people are talking about, and a lot of folks are worried about what's going to happen. We do have a strong confidence right now in our economy and what's happened with our economy, but there's always a little bit of a worry, especially if you're looking at buying a home. The biggest thing is, and Maggie, I know we spoke about this last time, but to refresh is that right now, the economy is very strong. We have a lot of people getting into the market. And we don't want people to be worried about what the real estate market is doing right now. We hear a lot of people predicting that we're going to have a recession or we may have a recession by the end of this year in 2020. And there might be a recession. But for a recession, it doesn't affect our real estate market like it did back in 2007, Because now we have a lot of first-time home buyers coming into our market. We actually have the greatest amount of first-time home buyers, which the average first-time home buyer is the age of 33. We actually have the greatest number of first-time home buyers coming into our market that we've ever seen, even more than we had during the baby boomer years. And what that means is that we have so many new people buying houses, and we don't have enough home builders building houses. So the amount of people coming into the market compared to the amount of homes that's being built is causing a supply and demand issue. And we all know what happens during a supply and demand issue. When we have more demand than we have supply, the values go up. And during a recession, if a recession happens towards the end of this year or next year, what happens for real estate is actually interest rates go down. So not only do we have this influx of people who are the age of 33 or older, first-time home buyers, we'll just label them that, but we also have lowered interest rates, which makes even more people buy. And we don't have enough homes for them because we have a low inventory throughout the whole nation, and our values are going to start going up. So we'll see actually just the opposite of what we've seen during a crash back in 2007. We're going to see our values actually jumping up, which is unfortunate. We don't want that to happen, but it's going to be what's going to happen from the market.
Yes, I hear that. So last week you mentioned some of the reasons we should purchase a second home now instead of waiting. Can we elaborate on that a little bit more to this week?
Absolutely. So we spoke a little bit on second homes and why you should buy. And obviously that's a huge reason of why to purchase now is the cost of waiting, which is what we spoke about. And when we spoke last week, we were talking about how much more, what we're going to see over a 6-month, 1 year, 2 year, and 3 year period, where up to, if you waited 3 years to buy your second home or even a primary, the cost on a $350,000 home you would be out, or the cost of living would cost you almost $53,000 with the things that we spoke about. Values going up. When values go up, you got to pay more on your payment because you're borrowing more money. And then the amount of amortization lost, which is the amount of money that's on your payment that comes off of your principal. So when you add all those up, it's almost $53,000 in loss over a 3-year period to not buy today.
I love every time I hear that. I just hope that the audience is understanding that, because for me, Tony, this is a big question and really speaks to the advantages of understanding how to work with money during your retirement years. So what are your thoughts around purchasing a home using cash compared to financing your retirement or vacation home?
Well, I am actually a huge advocate on that also, by the way.
Thank you.
Because the reason why is because I do love to have money to invest or grow for you, right? I always try to talk to people, first-time home buyers. I tell them the same thing every time. I don't allow my wife to pay $1 extra on my mortgage payment ever, ever. And the reason for that is because we take that $1 or $100 or the biweekly payment, which is extra payment per year, and put that into our 401k or put that into our IRA. That's going to grow for us at the rate of return that we get, right? Which is great, because we're going to put that money away for our future, and it's going to grow. When you buy a house, it doesn't matter what you owe on it, because your equity is always going to grow at the same amount, no matter if you have a 0 mortgage or if you have an 80% loan to value mortgage or a 97%. So the difference between paying cash and leaving your money in an investment account is that right now interest rates are between 3.5% and 3.75% on a 30-year fixed. It's like free money, right? We're not at the lowest we've ever seen, but we are very close to the lowest interest rates we've ever seen. So if you can borrow money at the mid threes or to 4, let's say, as long as your money in your investment account that you have with your financial advisor is making at least that percent on your money, it's like having a free mortgage. The amount of money that's going to grow at compound, I got a perfect example for you. Let's go over this one. So let's say we have a borrower that's looking to purchase a home, and they want to finance $200,000 or purchase. And they're trying to debate whether or not they should pay cash or they should finance. Well, if they were to get $200,000 and do a 15-year fixed rate, and I'm just going to use 4%, that's way high, we're closer to 3% today. But if they did a 4%, they're going to end up paying roughly $59,000 in interest, $59,000, almost $60,000 in interest over 15 years. Plus your closing costs, another $5,000, $6,000, let's say. It's going to end up costing you let's just round it up, $65,000 of interest and cost over 15 years. To take that same money and put it with your financial advisor and have him invest it for you for 15 years on a 6% return and never adding money to it, at the end of 15 years on a 6% return, you will have gained over $279,000 on a 6% return. Now talk to your financial advisor, because I'm not a financial advisor, but a 6% return is low over a 15-year period. So when you take the amount of interest that you would have paid, $65,000, compared to the amount of interest your financial advisor can make you, $279,000, you're literally giving up $200,000 by paying cash.
Wow.
It's a lot of money.
Yeah. So take and pay the smallest amount of interest and earn the most you can earn, but you do still have appreciation happening to balance out that payment, and you've left yourself in a very low risk situation and
Absolutely.
all the advantages. Do you
Absolutely.
think I'm saying that correctly?
You're saying it completely correctly, because you know what, Maggie? Cash is king. Equity is not cash. You can't get to your equity unless you pay to get it out. You're
Right.
already paying your closing costs when you buy the house, no matter if you pay cash or not. You have to do title work. You have to do all the other stuff. So why not just borrow the funds? And if you ever need to pay it off, All you have to do is ask your financial advisor for it. You take the money out, you pay it off at any time you want to. If your money's never is making less than the interest that you're paying, at that time, that's when you want to pay it off, which we'll probably never see that happen, hopefully.
Absolutely. There you go. So that is something. So talk about reverse mortgages. I know, I'd really love to hear, do they really work for retirees or semi-retired home buyers? And are there still the risks that were associated with them, say, 10 years ago?
Okay. Um, so a reverse mortgage is actually a wonderful product. It is an FHA loan, which is Federal Housing Administration. It was created by the government, so it's a government-backed loan. And these loans are for homeowners of the age of 62 years of age or older. Now, if you and your spouse are purchasing and one of you are under 62 years of age, as long as one of you are over 62, you can use the loan. So, yeah, there's a lot of myths about them. And one of the biggest ones that I just want to throw out there is that with a reverse mortgage, the bank never gets your house. You're literally just getting a loan, just like a conventional 30-year fixed, that has to be paid back when you sell the house. If you pass away, it goes on to your heirs. Your heirs then list the house and pay back what you owe. But the great thing about a reverse mortgage is that you do not have to, you can, do not have to make a payment for the entire time that you're alive and living in the house as a primary residence. It's a great product. You do have to put money down. It's usually around a 50% loan to value, meaning you buy a $400,000 home, you put about $200,000 in. The rest of it is a loan. They add the interest that you owe each year, and then you pay back the thing when you decide to sell it, or if you do unfortunately pass away and it goes on to your heirs, they would then sell it. But a great deal. And I'd like to give two examples if I can.
Sure.
Two things to think about on why to get a reverse mortgage or something you could do is example one. Let's say you're coming from an area up north and moving to Florida, and the place that you lived up north is lower cost. Now our prices aren't very high down here, but they're not really cheap, and there's some places with lower prices up north. So let's say you come from a place and you're able to have this beautiful 3-bedroom, 2-bath, 2,000 square foot house on 5 acres of land, and you come down here, Maggie, you take them out, of course, and you show them these houses, and they sold theirs for $250,000, and they can't get anything near what they got up there for $250,000. Well, you could actually take them, and that's all they have to spend, out to see a $500,000 home. They could purchase a $500,000 home for the same $250,000 they have, and never have a payment the rest of their lives. So be able to buy something nicer.
Huh?
Okay? So because they're putting half down and the rest of it's for the reverse mortgage, they don't have to make the payment. So they're able to get twice the buying power when they move down here for retirement. The second option they have, which is another great option, is let's say they do sell that $500,000 home up north and they move down here and they didn't have enough for their retirement and they needed more money. Well, in that case, you could go show them that same $500,000 house, but instead of paying cash, they take the reverse mortgage, they put half down, they borrow the other half, they never have to make a mortgage on it, and now they take that other half of the $250,000 they have, they put it into their accounts, and they have another $250,000 to live on to have a better life for themselves for the remaining life.
That makes good financial sense to me.
Absolutely.
Now, how does that affect their family? Let's say, so most of us want to leave something for our children. Not all of it. We want to spend as much as we can, but we still want to leave something for them.
Absolutely. I mean, the bottom line is that, first of all, most of our children make more money than we make when we are their age.
I know.
So we know that. But the second thing is that you're still leaving them your house. If you were to pass away, it's a non-recourse loan, meaning they never have to pay more than what you owe on it. So if you have a life insurance policy, if you have money left in the bank, they took that $250,000 and put it in the bank. They get all of that. Now let's say that you take that same $250,000 house